My dear students, welcome back to our channel. In this video, I will be explaining the Bcom third semester subject Advanced Accounting as prescribed by Osmania University and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 4 first important short question is: what do you mean by profit prior to incorporation? Profit prior to incorporation meaning, when a new company is formed, it often takes over an existing business. The time between the date of purchase, or when the business starts working, and the date the company actually gets its certificate of incorporation is called the pre-incorporation period. The profit earned during this period is known as profit prior to incorporation. It is not a company's own profit because the company was not legally in existence at that time. Therefore, this profit is treated as a capital profit, not a revenue profit. Accounting treatment. Such profit is not shown in the profit and loss account. It is transferred to the capital reserve in the balance sheet. Example: if a company takes over a business from 1st January but is incorporated on 1st April and earns 90,000 rupee profit till 31st March, that 90,000 rupees is profit prior to incorporation, treated as capital profit. Tip to remember: profit earned before birth of company is equal to capital profit. Next important short question is: 2. What is time and weighted time ratio? Time and weighted time ratio meaning, when a company takes over a business, the total profit for the year has to be divided into two parts: pre-incorporation, before company formation, and post-incorporation, after formation. To do this fairly, we use two ratios, time ratio and weighted time ratio. 1. Time ratio. It is based only on the length of time in each period. Formula: time ratio is equal to months before incorporation, months after incorporation. Example: if a business started on 1st January and the company was incorporated on 1st April, then time ratio is equal to 3 months, 9 months is equal to 1/3. 2. Weighted time ratio. Used when some expenses depend on time and business activity, like sales. It is found by multiplying each period's time with sales or other weight factors. Tip to remember: time ratio time only. Weighted time ratio time times activity. Next important short problem is: 3. What journal entries will be recorded for the following transactions on the dissolution of a firm? A. Payment of unrecorded liabilities of 3,200 rupees. B. Profit on realization amounting to 18,000 rupees is to be distributed between the partners Ashish and Tarun in the ratio of 5:7. Journal entries on dissolution of a firm. When a partnership firm is closed, dissolved, all assets are sold, and liabilities are paid through a special account called the realization account. Let's record the given transactions. A. Payment of unrecorded liabilities, 3,200 rupees. These are liabilities not shown in the books earlier but must be paid at dissolution. Journal entry: realization ACDR 3,200 rupees. To cash bank AC 3,200 rupees. Being unrecorded liability paid in cash. B. Profit on realization 18,000 rupees shared between partners Ashish and Tarun in 5:7 ratio. After settling all accounts, any profit is shared by partners. Journal entry: realization ACDR 18,000 rupees. To Ashish's capital AC 7,500 rupees. To Tarun's capital AC 10,500 rupees. Being profit on realization transferred to partners' capital accounts. Tip to remember. At dissolution realization, AC records all assets, liabilities, profits or losses till closure. Next important short problem is 4. State the basis for division of the following expenses between pre-incorporation and post-incorporation periods. A. Salary to working partner. B. Rent of building. C. Director's fees. D. Advertisement expenses. Basis for division of expenses between pre-incorporation and post-incorporation periods. When total profit is divided between pre- and post-incorporation periods, some expenses must also be divided fairly. The basis depends on whether the expense is time-based or sales-based. A. Salary to working partner. This relates to the old business before the company was formed. Fully pre-incorporation, company has no partners after incorporation. B. Rent of building. Rent depends on time, so it is divided according to the time ratio, example, 3 months, 9 months. C. Director's fees. Directors are appointed after incorporation, so this expense belongs entirely to the post-incorporation period. D. Advertisement expenses. These vary with sales volume, so divide them in the sales ratio, sales before, sales after incorporation. Tip to remember. Time-based time ratio. Sales-based sales ratio. Before company pre. After company post. Next important short problem is 5. From the following particulars ascertain the change in inventories. Raw materials purchased 3 lakhs. Work in progress 1st April 2020 20,000. Finished goods 1st April 2020 1 lakh. Raw materials 1st April 2020 70,000. Finished goods 31st March 2021 75,000. Work in progress 31st March 2021 25,000. Raw materials 31st March 2021 60,000. Change in inventories, step-by-step explanation. Let's find out how much the value of total inventories, stock, has changed during the year. Step 1. Write down opening and closing inventories. Opening inventories, as on 1st April 2020. Raw materials is equal to 70,000 rupees. Work in progress is equal to 20,000 rupees. Finished goods is equal to 1 lakh rupees. Total opening inventories is equal to 1,90,000 rupees. Closing inventories, as on 31st March 2021. Raw materials is equal to 60,000 rupees. Work in progress is equal to 25,000 rupees. Finished goods is equal to 75,000 rupees. Total closing inventories is equal to 1,60,000 rupees. Step 2. Calculate change in inventories. Change is equal to closing inventories, opening inventories. Is equal to 1,60,000 rupees to 1,90,000 rupees is equal to 30,000. Step 3. Interpretation. The total inventories decreased by 30,000 rupees during the year. Tip to remember. Closing opening is equal to change. If negative stock decreased, less goods left. If positive stock increased, more goods left. Next unit 4. Long questions. First important long question is: explain interim dividend, final dividend, proposal dividend and write about the accounting treatment of dividends. Interim dividend, final dividend, proposed dividend and their accounting treatment. A dividend is the portion of profits distributed by a company to its shareholders. It is a reward for investing in the company. Dividends can be of different types depending on when and how they are declared. 1. Interim dividend. declared by the Board of Directors during the accounting year before final accounts are prepared. It is usually paid when the company earns good profits mid-year. It is shown as a deduction from current profits in the profit and loss account. Example: if a company declares 1 lakh rupees as interim dividend in December, it will reduce that amount from current year's profit. Journal entry: interim dividend ACDR 1 lakh rupees. To bank AC 1 lakh rupees. To final dividend, declared after the end of the financial year in the annual general meeting AGM by the shareholders. Recommended by the Board of Directors based on audited profits. Shown as a liability until paid. Journal entry: profit and loss appropriation ACDR 1 lakh rupees. To final dividend payable AC 1 lakh rupees. 3. Proposed dividend. This is the dividend recommended by the board at year-end, but not yet approved by shareholders. It appears under current liabilities in the balance sheet until approved. After approval in AGM, it becomes final dividend. Accounting treatment summary. Type of dividend: who declares, when declared, shown in books. Interim dividend: Board of Directors during the year deducted from P&L expense. Proposed dividend: board, before AGM, end of year, shown under liabilities. Final dividend approved in AGM after year-end, transferred from P&L appropriation AC. Tip to remember: interim is equal to in between year, proposed is equal to waiting for approval, final is equal to after approval. So, dividends flow like interim, proposed, final, each with its own timing and accounting treatment. Next important long question is: 2. How are profits prior to incorporation treated while preparing the final accounts of the company? Explain. Treatment of profits prior to incorporation. When a new company takes over an existing business, some profits are earned before the company legally comes into existence. This profit is called profit prior to incorporation. It belongs to the period before the company's birth, so it is treated as a capital profit, not a normal business profit. 1. Why it is not a revenue profit? The company was not legally formed during that period, so it cannot earn profit in its own name. Hence, such profit cannot be distributed as dividends to shareholders. 2. Accounting treatment. Profit prior to incorporation is shown in the balance sheet under capital reserve liabilities side. It is used to write off capital expenses and losses that are not recurring. It can be used for writing off preliminary expenses, formation expenses, writing off goodwill or discount on issue of shares debentures, adjusting fixed asset losses or heavy expenses. It cannot be used for declaring dividends, paying routine business expenses. 3 steps to find profit prior to incorporation. 1. Divide the total profit for the year into 2 parts, pre-incorporation and post-incorporation. 2. Use time ratio for time-based items and sales ratio for sales-related items. 3. The portion before incorporation is equal to profit prior to incorporation. Example: a company took over a business from 1st January and was incorporated on 1st April. Total annual profit is equal to 1,20,000 rupees. Time ratio is equal to 3 months. 9 months is equal to 1/3. Pre-incorporation profit is equal to 30,000 rupees, shown as capital reserve. Post-incorporation profit is equal to 90,000 rupees, shown in profit and loss account. Easy tip to remember: profit earned before birth of company is equal to capital profit, shown in capital reserve, not used for dividends. Next important long question is: 3. What is Companies Act 2013? Explain the structure of Companies Act 2013. Companies Act 2013 Meaning and Structure. The Companies Act 2013 is the main law in India that controls how companies are formed, managed, and closed. It replaced the old Companies Act 1956 to make company law more modern, transparent, and business-friendly. This act applies to all types of companies, public, private, one-person, small, and non-profit companies registered in India. It aims to ensure good corporate governance, protect investors, and make doing business easier. 1. Meaning. The Act defines rules for forming a company, registration, incorporation, managing its affairs, meetings, accounts, directors, protecting shareholders and creditors' interests, regulating mergers, winding up, and penalties for non-compliance. Example: if you want to start a private company in India, you must register it under the Companies Act 2013 and follow its rules for accounting, audit, and annual filings. 2. Structure of the Companies Act 2013. The Act is a large and detailed law containing Part Details. Chapters 29 covering various aspects like formation, management, accounts, audit, winding up, etc. Sections 470. Each section explains a specific rule or procedure. Schedules 7 provide detailed formats, such as Schedule 3, format of balance sheet and profit and loss account. 3. Important features. One-person company. OPC allows single entrepreneurs to form a company. Corporate social responsibility. CSR companies must spend part of profits for social good. National Company Law Tribunal, NCLT handles company disputes. Mandatory rotation of auditors ensures fairness in auditing. Easy tip to remember. 29 chapters, 470 sections, 7 schedules. Think of the Act as a rulebook for all companies in India, guiding from birth, incorporation to closure, winding up. Next important problem is 4. From the following particulars of Mudra Co. Limited. For the year ended 31st March 2020, prepare profit and loss statement for the year ended 31st March 2020. Particulars amount Rupees. Opening stock of raw materials 1,20,000. Purchase of raw materials 5,80,000. Closing stock of raw materials 1,30,000. Salaries and wages 75,000. Interest on loan taken 15,000. Interest paid on debentures 12,000. Depreciation and amortizations expenses 29,000. Repairs and renewals 3,000. Traveling and conveyance 4,000. Advertising 9,000. Telephone charges 12,000. Sale of products 7,50,000. Audit fees 20,000. Rates, taxes and insurance 5,000. Interest received 6,000. Dividends received 13,000. Motor car expenses 16,000. Managers remuneration 18,000. Directors fees 7,000. Let's prepare the profit and loss statement step by step for Mudra Co. Ltd. in a simple way, easy to remember. Step 1. Calculate cost of raw materials consumed, direct expenses. Formula. Raw materials consumed is equal to opening stock plus purchases dash closing stock. So, raw materials consumed is equal to 5,70,000 rupees. Step 2. List all expenses, indirect expenses. Salaries and wages is equal to 75,000. Interest on loan is equal to 15,000. Interest on debenture is equal to 12,000. Depreciation and amortization is equal to 29,000. Repairs and renewals is equal to 3,000. Traveling and conveyance is equal to 4,000. Advertising is equal to 9,000. Telephone charges is equal to 12,000. Audit fees is equal to 20,000. Rates, taxes and insurance is equal to 5,000. Motor car expenses is equal to 16,000. Manager's remuneration is equal to 18,000. Director's fees is equal to 7,000. Total expenses, excluding raw material, is equal to 2,29,000 rupees. Step 3. Calculate gross profit. Formula. Gross profit is equal to sales dash raw materials consumed plus direct expenses. Here, assume other direct costs are included in raw material plus salaries etc. So, gross loss is equal to 7,50,000 to 7,99,000 is equal to 49,000 loss. Step 4. Add non-operating income. Interest received is equal to 6,000. Dividends received is equal to 13,000. Net loss after income is. Step 5. Profit and loss statement layout. Mudraco Ltd. Profit and loss statement for the year ended 31st March 2020. Particulars rupees. To raw materials consumed 5,70,000 by sales 7,50,000. To salaries and wages 75,000 by interest received 6,000. To interest on loan 15,000 by dividends received 13,000. To interest on debenture 12,000. To depreciation and amortization 29,000. To repairs and renewals 3,000. To traveling and conveyance 4,000. To advertising 9,000. To telephone charges 12,000. To audit fees 20,000. To rates, taxes and insurance 5,000. To motor car expenses 16,000. To managers remuneration 18,000. To directors fees 7,000. Net loss 30,000. Tip to remember. Step 1. Raw material consumed. Step 2. Add expenses. Step 3. Sales minus expenses is equal to gross profit loss. Step 4. Add other income is equal to net profit loss. Next important problem is 5. Ravi Teja Ltd. was incorporated on 1st May 2019 to take over the business of Rajender as a going concern from 1st January 2019. The profit and loss account for the year ending 31st December 2019 is an under. Prepare profit and loss account to find out profit prior and post incorporations periods. Let's solve this step by step in a simple and easy way to understand profit prior to incorporation and profit after incorporation for Ravi Teja Ltd. Step 1. Understand the problem. Company incorporated on 1st May 2019, but business existed from 1st January 2019. Need to divide profit into pre-incorporation, 1st January to 30th April, and post-incorporation, 1st May to 31st December. Total turnover is equal to 40 lakhs rupees pre-incorporation 12 lakhs rupees, post-incorporation 28 lakhs rupees. Total purchases is equal to 20 lakhs rupees pre-incorporation 6 lakhs rupees, post-incorporation 14 lakhs rupees. Concept to remember. Profits prior to incorporation belong to the sellers, Rajender. Post-incorporation profits belong to company shareholders. Step 2. Allocate expenses. We need to split expenses between pre- and post-incorporation. Method. Direct allocation, expenses directly related to pre or post incorporation can be taken fully. Indirect expenses, like salaries, rent, etc., are divided proportionally based on turnover ratio, 12L, 28L is equal to 37. Step 3. Prepare table for allocation of expenses. Particulars total rupees pre-incorporation, 3/10, rupees post-incorporation, 7/10, rupees. Rent and taxes 48,000, 14,400, 33,600. Insurance to lakhs 40,000, 72,000, 1,68,000. Salaries 18,000, 5,400, 12,600. Electricity 15,600, 4,680, 10,920. Audit fees 60,000, 18,000, 42,000. Office expenses 40,000, 12,000, 28,000. Directors fees 80,000, 24,000, 56,000. Advertisement 52,000, 15,600, 36,400. Discount allowed 12,000, 3,600, 8,400. Bank charges 16,000, 4,800, 11,200. Bad debts 24,000, 7,200, 16,800. Interest on loan 50,000, 400, 15,120, 35,280. Preliminary expenses 4 lakhs 80,000, 1 lakh 44,000, 3 lakhs 36,000. Total expenses 12 lakhs 40,000, 3 lakhs 72,600, 8 lakhs 67,400. Step 4. Allocate incomes. Gross profit is equal to 12 lakhs. Discount received is equal to 30,000. Commission received is equal to 10,000. Split proportionally, 3:7 ratio, same as turnover. Particulars total rupees pre-incorporation, rupees post-incorporation, rupees. Gross profit 12 lakhs, 3 lakhs 60,000, 8 lakhs 40,000. Discount received 30,000, 9,000, 21,000. Commission received 10,000, 3,000, 7,000. Total income 12 lakhs 40,000, 3 lakhs 72,000, 8 lakhs 68,000. Step 5. Calculate profit prior and post incorporation. Profit is equal to income dash expenses. Pre-incorporation profit is equal to 3 lakhs 72,000 to 3 lakhs 72,600 is equal to 600, negligible, approx 0. Post-incorporation profit is equal to 8 lakhs 68,000 to 8 lakhs 67,400 is equal to 600. Here, the numbers are almost balanced due to proportional allocation. Step 6. Key points to remember. 1. Profit prior to incorporation belongs to seller. 2. Profit post-incorporation belongs to company shareholders. 3. Proportional allocation use turnover ratio or time ratio if turnover not given. 4. Always match income and expenses in the same proportion for accuracy. Electric light bulb memory trick. Pre-seller, post-company, income and expense ratio is key.